Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
This morning's podcast features Mr. Keith Lanton, with commentary by Brad Harris, Director of Fixed Income at Lanton.
Hi, good morning, everyone. Hope all had a fantastic weekend. Feels like fall is getting started here in the Northeast. Welcome everyone back to a Monday morning after a strong equity rally at the end of last week, and we'll talk about that. Talk about some different ideas. Talk about the news this morning. Going to get started today. Talk about something we've talked about a little bit a couple of weeks ago. Going to build on that, and that is body language presentation. How this influences what others think of us, how we react to others, and how we can incorporate some of this knowledge into our daily interactions with one another, with coworkers, with family, and with strangers, and sometimes with authorities if we are dealing with things like police or military or government workers. Some things to think about. So some things. Body language, focus. So many words coming from nonverbal clues. Many people say that more information is gathered from how someone interacts and reacts and what their body is saying, and less important is what their voice or their mouth is saying. So some things to think about. If you see someone put their hands on their knees, especially if they lean forward, typically a clear sign in the mind of the person that's taking that action that they are ready to conclude a conversation, conclude a meeting, that whatever is being discussed is over. They're getting ready to take leave, and that is a cue. Another cue is if you see someone standing or even perhaps sitting, and they point their toe upwards. Perhaps you see someone on the phone standing and their front foot toe is pointing upwards. That's typically a sign that someone is in a good mood, possibly hearing something positive. If you're interacting with someone and you see that their feet are together and you notice them spreading their feet apart, that means that person is becoming perhaps increasingly unhappy with the conversation or with you, and it's a signal. Another thing that you personally may have experienced is perhaps you've heard news that you didn't like while you were eating, and suddenly you felt that loss of appetite. In the extreme example, people might vomit or regurgitate if hearing something traumatic, and that is the body sending a message. Body saying there is no time for digestion. You've got to lighten your load and prepare because there's something that you have to address that's more important than food. Speaking of the workplace and the signaling or the messaging that we send, one of the greatest signals or messages that we send, whether aware of it or not, is our clothing. Whether or not we're wearing a suit, casual clothes, casual professional, if we're dressed sloppily, typically sloppy dress or dress that is indicative of not being taken seriously is typically a sign that someone is preoccupied with something else. Perhaps they're ill. So if someone is dressed sloppily, typically it indicates that something more significant is going on in their lives, or perhaps they have a longer-term issue if they're consistently dressed sloppily. Obviously, you see that frequently with the homeless, people who have a lot of other things going on in their lives, and dress is one of the telltale signs, and we as a society, read how people are dressed subconsciously to determine status, to determine whether or not that person is someone that we are going to view with authority, if that's a person we're going to view with respect. And clothing in particular, a lot of times the torso or the chest area are often billboards about which we advertise our sentiments and our status. Often you'll see worn on the chest are things like badges or military decorations. Athletes will wear their team logo. High school students will wear a jacket that say varsity. All of these things to pinpoint who we are and what we've achieved. During courtship or dating, people will focus on perhaps ladies will wear a top that exposes some of their shoulders. All of this in an attempt possibly to get attention, to enchant the other person that we are interacting with. Men might, if they're muscular, might wear a tighter shirt, all to portray something to the other person that we are speaking with or interacting with. And this is and dress and how we interact is sort of the core example or the height of how you know it's something that's important is when you have an event to go to typically that you view as important, whether it's a wedding, a prom, first interview, first day on the job. Typically, you are very focused on what it is that you're going to wear to that event. And that is a sign, once again, that you as well as society view that message that you're sending as something that is representative of who you are and how others may feel about you. We're going to move on to financial markets this morning. First, give a recap of where we were last week and how we're starting out this week. Taking a look at the averages, the S&P closed last week at 29.79. It was up about 1.8% for the week. S&P is now up year to date about 20%. Interestingly, over the last 12 months, it's up about 5.6%. Dow last week closed at 26,797, up 1.5% for the week, just under 17% for the year. Nasdaq was up 1.8%, up about 23% for the year. Comparing that to foreign stocks actually outperformed U.S. stocks last week, up 2.2%, but trailing for the year, up 12.6%. And emerging markets, strongest gainers on the week, up 2.4%. A lot of that on the sentiment coming from the Chinese trade talks, which is what the markets were hoping for more positives coming. And therefore the emerging markets up strongly, but year-to-date emerging markets lagging significantly, up 6.7%. Taking a look at Treasury bonds, Treasury yields moved higher. For the year, though, the 10-year Treasury is up 12% year-to-date. To put that in perspective, this morning, though, we are seeing futures higher, but Treasuries on the lower side. Dow futures are up about 60, S&P futures about 11 over fair value, Nasdaq futures up about 20 over fair value. We are seeing Treasuries pull back on some continued optimism about trade and the U.S. and China. This morning, some comments I'll mention from Treasury Secretary Mnuchin, but last I looked, the 2-year Treasury was up 4 basis points, 156 yield. The 10-year also up 4 basis points, 159, and that spread back to positive. And the 30-year up 4 basis points to a 206. Also seeing modest strength in oil, up about 0.5%, gold up 0.3% this morning. Treasury Secretary Mnuchin was on Fox Business this morning. He was discussing hopefully achieving a bipartisan solution on Fannie Mae and Freddie Mac over the next 3 to 6 months. He said that if there cannot be congressional support, that the administration will take unilateral actions. He did say there's a slowdown in the world economy, but he highlighted the U.S. as remaining as a bright spot. He said he felt that the trade dispute was not impacting the U.S. economy, but he did go on to say that trade talks will take place in Washington, D.C. late September on a lower level and a higher level in early October. He also reiterated that President Trump is, quote-unquote, perfectly happy to continue tariffs if China does not agree to a good deal. Some companies in the news this morning. The biggest event of the morning is that Elliott Management has revealed a $3.2 billion stake in AT&T. sent a letter to the company's board detailing a plan to improve AT&T's operations and stock price. Elliott said its plan could lead to a share value of $60 or more by the end of 2021. AT&T stock has been vacillating up anywhere between 2 and 3 points throughout the morning on that announcement. Also in the news this morning, Amgen had a results of a phase 1 drug, and the stock's down about 4% this morning. Also, the discount airline Spirit is down about 2%, saying that third quarter guidance affected by Hurricane Dorian. They have a lot of operations down to Florida, and saying that impacted the quarter significantly. Also, Boeing in the news this morning. Boeing suspending load testing for its new 777X aircraft, saying it encountered an issue, didn't specify the problem. Media reporting that a cargo door failed a ground test. Also, Boeing in the news. Barron's wrote an article suggesting that even if Boeing is able to secure approval from the U.S. FAA for the 737 MAX, that approvals from international safety agencies may come one at a time and may come more slowly than the markets are currently anticipating. What do we have to look forward to this week? Tomorrow, Tuesday, Apple is hosting its product launch in Cupertino, California. Company is expected to unveil 3 iPhone 11 models, as well as possibly some other products, some other updates to some of their software. So always an event market will be focused on the Apple event. Barron suggesting that next year's event could perhaps have more grandiosity associated with it, as next year it's expected that 5G iPhones will be launched. On Wednesday, we get the producer price index for August, expected to have a 0.1% rise, and the core PPI is expected to rise 0.2%. Thursday, we get conference calls to discuss earnings from Broadcom, Kroger, and Oracle. One of the other big events of the week on Thursday, the European Central Bank announces its monetary policy decision. Market expects the ECB to cut its deposit rate from the current negative 0.4%. Futures markets predict a 50% chance of a 10 basis point reduction to negative 0.5%, and a 50% chance of a cut of 20 basis points to negative 0.6%. Mind-blowing to be talking about negative interest rates and rates that are that negative. Quite surprising for those of us who have been around, and seen multiple markets. Talking about Friday, we get the Census Bureau reporting retail sales for August. Retail sales, critically important gauge of the U.S. Consumer and the U.S. economy. The expectations are a 0.1% gain. That was after the 0.7% gain in July. Interesting to note that individual investors remain cautious, or some could argue bearish, and this is something that's somewhat of a contrarian indicator. In other words, individuals are bearish. Perhaps that's a bullish sign for markets counterintuitively. The most recent survey showed that bears outnumbered bulls by 11 percentage points. And interestingly, that's an improvement from last week when it was a 16-point differential where bears outnumbered bulls. But still lots of pessimism. Some are even suggesting that the markets, individual investors, fairly close to panic. So if you're looking for a silver lining, bad news is good news. Perhaps you can take heart in the fact that if you're feeling negative, you're not alone, and that's not necessarily a bad thing going forward. Barron's ran an article, Treasury bonds are now riskier than stocks. I think Brad said something similar last week, so kudos to Brad, 1 week ahead of Barron's. Byron Wien at Blackstone said the market right now is making several assumptions, one of which is that some sort of trade deal with China will happen in the next 6 to 9 months. Interest rates and inflation will remain low, and the stock market is attractive with stocks yielding more than bonds. Mr. Wien points out that the S&P 500 dividend yield is nearly 2%, 10-year Treasury yield 1.55%. marking a rare time when stocks yield more than government bonds. We talked about this flip last week where stocks exceeded the bond yield even on the 30-year Treasury, although that's no longer the case this week, but certainly on the 10-year. Barron's goes on to speculate that the risk in Treasuries is now greater than stocks, and the upside potential in government bonds looks limited. 30-year Treasury now yields, I think we just said, about 2.06%, which is near its record low. Put things in perspective, if the 30-year Treasury were just to go back to 3%, which just a few months ago seemed like a really low rate, that would result in a fall of the long bond price of about 20%. Barron's went also on to discuss interesting developments in the REIT space. You may have read that WeWork is thinking of going public. WeWork is one of those unicorns, a company with $1 billion+ market valuation that's currently private. And WeWork has been talking about coming public initially with a market valuation of around $45 billion. There's now talk that valuation could be cut to as low as $20 billion, or a deal could be put off entirely. Put WeWork into perspective, operating losses of $1.4 billion on $1.5 billion in revenue in the first half of 2019. On top of that, the financials aren't super transparent, and the company has grandiose ambitions for a company that rents office space to individuals. They state in their prospectus that their mission statement is to elevate the world's consciousness. Barron's suggests taking a look at a couple of competitors to WeWork that are significantly profitable, and they argued undervalued as opposed to overvalued. They suggest taking a look at a pair of real estate investment trusts focused on the Manhattan office market, SL Green, symbol Sam Lucky Golf, and Vornado, symbol Victor Nancy Oscar. Despite all the talk about Google and Facebook snapping up office space in Manhattan and possibly even Amazon coming back and taking more space, Manhattan is actually right now viewed as the nation's weakest major office market, and as a result, SL Green and Vornado have badly lagged behind peers and a strong REIT market this year. SL Green is up about 2%, Vornado up about 1%. The Vanguard Real Estate ETF, VNQ, is up about 25% to put the underperformance into perspective. Both SL Green and Vornado yield about 4%, and the combined market value of these two huge real estate companies here in the Metro New York area is $19 billion. That's actually slightly less than the reported low-end valuation of WeWork, and that's putting these two companies together, still coming in slightly below the valuation that they're talking for at WeWork. Article quotes a partner at Sandler O'Neill, suggesting that at SL Green, management has been doing everything that you would want them to. They've been selling assets, buying back stock, which happens to trade based on their estimates at a 30% discount to the net asset value, and generating growth in the portfolio. The analyst goes on to state, unlike WeWork, both SL Green and Vornado are asset-rich and valued at a discount to private market transactions in Manhattan, and that's despite the fact that the Manhattan real estate market, as I mentioned, has been lackluster at best. Another area where Barron suggests perhaps you could find some value is in European equities. European equities have returned 1.7% annually in the past 5 years. U.S. equities have returned about 10%, 10.7%, meaning that European equities have trailed U.S. equities by about 9% per year over the last 5 years. And Barron is intimating that perhaps some of that weakness will reverse. Part of the bullish case for European stocks is that yield-starved European investors will gravitate towards equities, given that bond yields in Europe, as we just mentioned, are so low. We talked about further negative interest rates coming. German Bund is at negative 0.6%. The German stock market has a dividend yield right now of 3.3%. The UK bond market is yielding about 0.6% to the positive side, yet the UK stock market, obviously all sorts of issues with Brexit there, but the UK stock market dividend yield 5.1%, so perhaps a lot of that being priced in. Article suggests companies like Royal Dutch Shell and BP may be attractive, yielding over 6%. They discuss that HSBC is yielding 5.4%, UBS 6%. Daimler Chrysler, no longer Chrysler, just Daimler, and BMW both yielding over 5%. So perhaps some value there and certainly some yield. Barron's also talked about some value stocks here in the United States, and they talked about these value stocks not only being cheap, but perhaps actually having some momentum, something you don't necessarily associate with value these days. One of the companies they were very prescient regarding was AT&T, mentioned in this article. That stock obviously getting a boost this morning on the news about Elliott Management, and Barron's suggesting that AT&T, which at the time was yielding about 5.7%, free cash flow yield of about 10.5%. Obviously, Elliott agreed with that sentiment, and they talked about the fact that AT&T was reducing debt, and they felt that as that debt got whittled off, that investors would really grow to appreciate that dividend. Also mentioned in the article, one company is the U.S. drug distributor McKesson, symbol Mary Charlie King. They deliver about a third of prescription medicines in the United States. 5 years ago, the stock traded a premium to the S&P 500. Today, it trades at less than 10 times earnings, 40% discount to the market. One reason is that policymakers are promising to carve costs out of healthcare, especially drugs. Another is that Amazon is interested in the drug business. And a third is that litigation over the opioid deaths could not only cost manufacturers, but also distributors billions of dollars. Barron says, taking all those factors into consideration, they still find the valuation compelling. They say that operating margins in the drug distribution space are less than 2%. That's not exactly a market that's ripe for Amazon disruption. Free cash flow is about $3 billion a year. They feel that'll be enough to cover legal settlements, and they continue to argue that revenue growth remains strong. And they suggest that if and when an opioid settlement were to come, that you could see the stock start to lift. Finally, third company mentioned in this article is D.H. Horton, symbol Delta Hotel Ida. The thesis here is that D.H. Horton has created a division called Express Homes, focused on building value-priced houses, and that division now accounts for 30% of all the homes that they sell. Millennials are starting to become more and more engaged in home buying. 64% of millennials say they were extremely, very, or somewhat likely to buy a house in the next 2 years. That's up significantly from last year. Millennials of house buying age will peak in 6 years at 29 million. That is 3 million more than the baby boomer peak in 1987. Finally, before I turn things over to Brad, I'm going to talk about the headline article in Barron's and then turn things over to Brad, talk some more about the market and the bond market in particular. Barron's ran an article I think that is critically important just to think about as you talk to investors, as you think about making investments. What Americans can learn from the rest of the world about retirement, and just thinking about the aging of the planet and what impact that will have not only on our lives from a demographic standpoint and a socio-political standpoint, but also how you go about thinking about investing in an age of agraying in the entire world, not just here in the United States. Article points out we are at the beginning of a global aging boom, and countries all over the world are facing similar challenges. There are more adults over 65 in the world than there are children under 5. By 2050, 1 of every 6 people will be over the age of 65, and that potentially could be a big problem. Japan is at the leading edge of the trend. 28% of its population is already over 65. China has a bit more time, but not much. Its society is aging faster than any other on the planet. Life expectancies in China have lengthened by 30 years within the last 50 years. That's roughly half the time that we in the West have seen life expectancies expand by 30 years. And what that means is that China has had less time to prepare for an aging population. Put things into greater perspective, if you go back to 1950 and take a look at children between the ages of 0 and 14, they made up 34% of the world's population. 65 plus in 1950 was 5%. If you look out just 30 years, children under the age of 14 will make up 21% of the world's population, down from 34%. Those over 65 will make up 15.9% of the population, up from 5%. So we are seeing significant changes in the ages of societies throughout the world. What we're seeing in Japan, and perhaps we'll start seeing it in the United States, is those who are aging are working longer. 59% of men in Japan that are between 65 and 69 are working. In the U.S., that number is just 38%. What we're also seeing in Japan, and they're talking about it in France, in Great Britain, we're seeing it also being talked about in other Asian countries, is increasing the age at which individuals are able to tap into a country's national pension system. Japan talking about raising that age to 70. We talked about people in Japan working longer, and in many cases, that longer work is not necessarily, although it certainly is a component, only because it helps financially. What the Japanese are saying, and they have a word for it, that word, and excuse my Japanese if anyone out there knows it, ikigai, which is a view that one's life is still worth living. And what the Japanese have found is that people have a much higher self-esteem. They tend to be much healthier if they continue to work than if they stay home, and that lowers the costs of health care and also improves the psychological benefits to the elderly and to society as a whole. What's interesting is in the United States, 70% of older people say they want to work past the age of 65, but only 20% in the U.S. Are actually able to continue to work. Also of interest, thought this was interesting in terms of caregiving. In China in 2013, China passed a law requiring children to visit aging parents. Not a choice, it's a mandate. And in China, there's going to have to be a lot of visitations going on because by 2030, 360 million Chinese, almost the entire population of the United States, will be older than 60 years old. This is a byproduct of the fact that China had a one-child policy, and the graying of China is a significant cause of the fact that there's a lot more elderly relative to youth than has traditionally been seen in China. So when you think about investment theses, whether it be healthcare, pharmaceuticals, retail drugstores, whatever the thesis is you're thinking about the graying not only of America but of the planet may have a strong influence on investment theses over the next several decades. Perhaps it even has a strong impact on the bond market as these people that are graying seek to save more and take less risk. I'll turn it over to Brad and hear his thoughts on markets this morning. Good morning, Brad.
Hey, Keith. How are you? First of all, I hope everyone had a great weekend. I'm going to start with something that I was really contemplating whether I do or not, but it's a little bit of a la Keith Lanton op-ed. This week marks the 18th year of 9/11, and just want everybody on Wednesday just take a moment and be thankful for life and health and everything that we have. And I mention it because a lot of my bond decision-making comments come from that. And we're always here to live another day. Human nature is basically to be greedy, and we always want the most. So many of my clients always say to me, give me the best rate of return, but I don't want to lose a penny. And I always say that's, you have to find somebody else to do that for you. But that's why I keep harping, and I am beating the dead horse again on premium municipal bonds, higher coupons, shorter calls, take some of the volatility out. There are times to be greedy and times to get the max yield, times to reach out and do it. But as advisors, we have a responsibility to at least tell our clients that You may take some of the volatility out of the trade, out of the holding, if you buy these structures. The ultimate goal is that we're waiting, living, and breathing for another day, and I hope everybody has a great week, and thank you. Bye.
Thank you, Brad. Have a fantastic week. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.